Foster, one of the premier investor coaches of South Florida with SmartPlan Investing. We have offices in Jupiter, Florida and Atlanta, Georgia. I empower female entrepreneurs to eliminate confusion, gain insights, and grow their wealth while discovering their true purpose and sharing it with the world. Today, I'm continuing my series on 4 common investing pitfalls. Now, if you have just joined us for the first time, I want you to know that there is an introduction video and there is a video on common investing pitfall number 1, stock picking. So before you proceed, we encourage you to go back and find those videos if you haven't already seen them, and you can find those on our YouTube channel. One of the areas that we really focus on with investors is helping them to uncover their blind spots because, and I'm going to illustrate this in a moment, the blind spots can be a real danger when it comes to investing, just like the pitfalls. So this circle here represents like all the information that's noble in the universe, right? And this little circle right here, right, that represents maybe all the information that's in Google. Now this first piece of the pie here is what we know. Now this isn't drawn to scale because obviously no one here knows more than Google, but we're just doing this for illustrative purposes. This area here would be representing what we don't know. Now underneath here would be the things that we don't know, which are also called our blind spots, right? Because if we don't know what we don't know, and we can't see them. Now there's also what we know that's not so. It means it's information we know, but it's wrong. So that is also in our blind spots. Now, let me ask a question. What can you do with what you know that you know? You can use it. And now what can you do with what you know that you don't know? You can learn it and move it to what you now know, right? Now, what can you do with what you don't know that you don't know? Absolutely nothing. So in this video today, we're going to help you to uncover a blind spot that you might have when it comes to investing, and we're going to talk about market timing. Now, right now when I'm shooting this video, we are in the middle of a pandemic of 2020 called the coronavirus or COVID-19. Many people have stayed home because they maybe aren't essential workers, and with that, a lot of people are cleaning out closets. So I think that if we start with this story, it will help you make a lot more sense when we talk about what market timing is. So I don't know about you, but I do this often when I clean out my closet. I probably held on to things for a long time, and finally I'm like, this is no longer cool, it's no longer in style, it's never coming back, I'm just gonna get rid of it. I've done it with jean jackets. I had these really cute pink corduroy pants that I loved. They were even a little like bootleg. And I remember when skinny jeans came in and skinny pants, I thought there's no way I'm wearing that. I'm always gonna wear bootlegged pants. And that definitely has changed. And I even remember talking to my mom when I was a kid, and she said, oh, I used to have bell bottoms, and then those came back in style. And so a lot of times styles come back, and then there's some things that are just timeless, or they just come back more often. So I've done this many times where I've cleaned out my closet, and maybe you're doing it right now. You're cleaning out your closet and you're saying this item isn't cool anymore. It's not in style, doesn't look good on me or whatever, and so you get rid of it. So just like when you're cleaning out your closet and getting rid of something that doesn't seem to be in style or doesn't seem to be cool anymore, some investors do this when it comes to their investment. Now, there's 2 different types of investors, right? There's investors who say, when the market's going up is when I want to buy, and when the market's going down, like it did in March 2020, during this pandemic, when it took over 30% drop in a very short amount of time, wanted to sell and get out when it was going down, right? So that's one type of investor, wants to buy when it's going up and wants to sell when it's going down. And then there's the other investor who says, I want to buy when it's down and I want to sell when it's up. Now we're going to get into that in a little bit, because that investor is actually a much more rare investor. But as humans, we have this thing in our brain that's called an amygdala. and it fires off when we feel that there is some sort of danger. So if a kid goes darting into the street, we don't sit there and think, should I be worried? No, we just react. I mean, you become Superwoman, right? Or Superman, and you're jumping across cars and buildings, and you're grabbing that child and you're bringing them to safety. And that amygdala serves us well when there is a danger. The problem is when there is a probable danger, like I could lose all my money. Then our amygdala fires off, and our human nature, our fears, anxieties, and all this stuff, we want to move away from the danger and towards safety. And so what some investors will do is they will sell something when it's going down, and then they'll try to wait when they perceive that the danger is gone, when the markets have gone up for a long enough period of time where they feel it's safe, and try to get back in. Now I want to just go right back to Business 101. I'm sure you've worked for a company, maybe even owned a company, right? How do you make money as a business? You have to either buy a product or a service at a lower cost and then resell that product or that service at a higher cost. So you have to buy low and sell high. The same is true in the stock market. Yet investors, when the amygdala is firing and there's fear, they can often do the complete opposite. So we believe that market timing in all its forms is destructive behavior. And back in 2007, we had two elderly clients, women, who I know for them, their American dream was that they would not become a burden to their family in their old age. Now, in 2007, the fourth quarter, the market started seeing some negative returns, but it wasn't anything to be too worried about. We have that, from time to time, the markets are going to go down. But we went through 2008, and most investors remember the housing bubble, the credit bubble, and we went through literally a year and a half of negative returns. So here these women are thinking, this is all I have for the rest of my life. It's gonna go to zero. I'm gonna lose everything. I'm gonna become a burden. And no matter what amount of coaching, that amygdala was firing, and they were trying to flee from the dangers or the perceived dangers. And they got out of the market 3 to 4 weeks from when the market started taking its recovery. Now they told us, I will never get back in the market. And what happened is they weren't able to recover their losses. They locked in a year and a half worth of losses, never to recover again. Now, the investors that actually stayed put recovered in about 2 years. Now, there are studies, and we're not going to show them today, but we show them in our bi-weekly coaching calls. There are studies that show the investors that actually stay put versus those who try to get in and out of the market at the right time actually fare better. So staying put, they would have fared better than getting out. And, they got out at just the wrong time, because if they just waited a few more weeks, the market started to recover. So that is one way that market timing shows up. Now we're seeing market timing another way right now. There's actually 2 ways we're seeing it. So one way is that there are people who don't have money in the market, or they have some money on the side and they're trying to figure out, well, when's the best time to get in the market? We all know that we want to buy low and sell high. We've already discussed that, right? So stocks were on sale for the first time in like a decade. So the smart investors are saying, I want to get in. I want to get in as quick as possible. I want to take advantage of while stocks are low, right? So you have that one type of investors like, I want to get in now. But then you've got the one who's like, I'm not sure. Is it going to go down even more? Will it go down again? Is this the bottom? They're trying to time and figure out when is the time to get in and out. Now, what I do know is that now is always the right time to be a prudent investor. Do I know if the market's going to go back down? No, I don't. At least I don't know if it's like in a few months, will it go back down? Will it go down more than it went down in March 2020? I don't know. Have we seen the bottom? I don't know. There's just so many unknowns when it comes to investing. But if you have an investing strategy that's designed to always be buying low and selling high, because there are different areas of the market that you can invest in, there can always be buying opportunities. You don't have to try to figure out if now's the right time. So unfortunately, the ones that's sitting there on the sidelines saying, I'm not sure, should I get in now or should I wait because it could go back down, actually missed out on about a 15 to 20% opportunity, because the market has already, in a very short amount of time, less than 2 months, has already taken a huge recovery. So now if they want to get in, they'd actually be buying at a higher price than they would have 2 months ago. So as you can see, market timing just does not work. And we believe that market timing in all its forms is destructive behavior, and that you can utilize an investment strategy, a structured portfolio that's designed to buy low and sell high. So there's a few more points that I want to make real quick, and that is that if you get out of the market when it's down, you miss the recovery opportunity and you lock in your losses, right? If you're waiting on the sidelines and there's a run-up, there's an opportunity there that is missed. And then there's also market timing in disguise. So you may not be handling your investments, you may be hiring somebody else to do that for you, and you can believe that you are a long-term investor, that you don't believe in market timing, and even the advisor can tell you that they don't believe in market timing. But another way that we have seen this show up is that the fund managers of the mutual funds that you invest in, they're the ones that are actually picking and choosing what goes into the portfolios many of the time. Now, they might be doing the market timing for you. And there's a difference between market timing and rebalancing. So rebalancing, and we'll get into that at a later time, is actually just putting your portfolio back to the targets, or let's just say the percentages in which you agreed that you wanted your portfolio to be invested in. So for example, maybe you wanted it, or maybe that portfolio was designed to be in 10% of the US large or the S&P 500. Well, as the S&P dropped, it becomes less than 10%. So rebalancing would just sell off the thing that's high, buy the thing that's low, and put it back to its 10%. That's not market timing. That's rebalancing. Market timing is moving the assets based on a forecast or prediction, trying to figure out what's going to do well or not do well in the future. It's completely different. That's usually selling low and buying high, versus when you're doing rebalancing, you're buying low and selling high. Now, a fiduciary is somebody that has to do what's in the client or investor's best interest. And it doesn't necessarily mean just one way that you can measure that is if the investment advisor can offer two similar products that have the same similar risk in it, that they wouldn't sell you the thing that's more expensive, right? That's one way a fiduciary has to comply. Another way for us is that we have to do what is best for an investor. And so we believe that market timing in all its forms is destructive behavior, and we have what's called an investment policy statement. And it's inside every application for every client. It tells them that we do not do any of the common investing pitfalls, and we will never do them, and we have to do what's best. See, we only win if you win, right? And so we're looking at you winning long term, not just in the short term. So of course, if the markets are going down and our fee is tied to that return, we would want to stop the bleeding as well. But unfortunately, if we look long term, that's not what's best for the investor. And so therefore, we would not engage in that activity. As a fiduciary, we will always act in the best interest of the client based on their risk tolerance, their goals, and their needs for the future. We encourage you to continue watching our series on the Common Investing Pitfalls, and feel free to visit our website. And if you have any questions, we encourage you to register for one of our upcoming investor breakthrough sessions, and we'd be happy to answer any questions. Just reach out to us.